I started my journey as a value investor 22 years ago, and I quite by accident heard about Warren Buffett for the first time. And unlike you, when I heard about him, I was 30 years old, so I was much older. And when I read about him, I was really stunned. I basically so I haven't been to business school. I'm an engineer by training. All of you probably know a lot more about finance than I do. But I was really stunned with Warren Buffett's approach and the way he had been so successful, and the crux of his success, at least what I took away from what I read in 1994, was a quote by Albert Einstein, which is compounding is the eighth wonder of the world. And so even though Einstein was a physicist, he actually figured out a few things about compounding. And obviously in '94, when I had read about Buffett, he had been compounding at the rate of about 25, 26% a year. And 26% is a magical number. And I thought it was a magical number then because if you compound money at 26%, it doubles in exactly 3 years. So if you have $1,000, you compound at 26%, you're going to have $2,000 in 3 years, and so on. And if you go for 30 years, that's 2 to the power of 10. And this group doesn't need me to tell you that 2 to the power of 10 is 1,024. So we throw away the 24, it's 1,000 times your money. So if you had $1,000 and you compounded at 26%, 30 years later, you would have $1 million. And if you had $1 million and you compound at 26%, 30 years later, you'd have $1 billion. And that's basically the key to Buffett's success. And so I thought it was worth trying to do what Buffett did. Of course, no, we're never going to have another Warren Buffett, but I thought it was worth trying to compound at high rates. And so I actually gradually over 5 years switched from being a CEO of an engineering company to eventually being a hedge fund manager. And the key nuance, or you could say mental model I used was very simple, which is I looked for companies that were selling for half or less than what they were worth in 2 or 3 years. So if I could find a dollar bill for 50 cents, then what that meant is that if it got valued as a dollar in 2 years or 3 years, I would be compounding at 26%. And if it happened in 2 years, it would be even higher. It'd be like 35, 36%. And if it happened in 2 years, it'd be 26%. And so I said, it's worth trying to seeing if we can find these 50-cent dollars, because 26% sounds high, but finding things that are half off in an auction-driven market is not, I didn't think it was that hard, and I thought it was worth trying because the rewards are so high. And so that's what I embarked on doing. Is I said, okay, let's try to find these, dollar bill for 50 cents, and then you just sit back and wait for 2 years or 3 years, and markets are weighing machine in the long term, and they'll get reweighed accordingly. And for the most part, if I look at my my performance from 95 until let's say 2014, it's done about the 26% approximately. Last 2 years, I'm down about 1/3, so we're taking it down a little bit. But we think in the next few years we'll make it up. And but this journey, it's been 21 years since I started doing this, and I had $1 million in 95, and I wanted to try to see if that million in 30 years could convert to $1 billion. So I said, okay, basically We have the million. I don't really need it for anything. I'm going to try to put it in this Buffett engine of compounding, and I want to see what happens to it. And the good news is that even if I miss by 90%, it's still a big number. Even if I miss by 95%, it's still a big number. They're all acceptable numbers. So it sounded like a good game to play. And when I first set up the first set of stocks I bought in 1995, and this is, I had 1 year of experience reading about Buffett. I didn't have a lot of experience. I hadn't gone to business school, etc. And so I basically used to just, if I found a company, I would make a 10% bet. So my portfolio of 1 million stocks basically got $1 million got divided into 10 stocks. Okay. And so I bought these 10 stocks, but then I had an interest at that time in making investments in the Indian market, because there were some companies I had noticed in the Indian stock market that looked very compelling. And it was very complicated at that time in 94, 95 to invest in India, especially as a US resident. And for example, they didn't have DMAT. So if you bought shares, this is like 21 years ago, they gave you physical stock certificates. And also, the Indian government said that if I brought in dollars and I bought Indian stocks, I'd be able to take the money back without taxes back in dollars. And the country had a lot of exchange controls. So I didn't actually believe them. I was a little skeptical that a country which had all these exchange controls would kind of honor these things that they were saying, if you will. And so I was skeptical. So what I did is, out of the $1 million, I only allocated $30,000 to India. And the $30,000 I allocated to 4 stocks. So I had to physically go to Mumbai. I opened a brokerage account, opened the bank account, and then I bought these stocks. And then a few weeks later, I got these physical stock certificates in California, and they were almost falling apart. Like they looked like they almost were worthless. They looked so beat up. And so one stock I bought, which was half of the 30,000, 15,000, was an IT services company. That was the business I was in, and Satyam Computers. And then 3 others. There was one. One was a broker through whom I bought the stocks, and 2 were courier companies. Kind of like FedEx or DHL, because India had very bad postal system. So I thought that as the economy grew, these companies that were basically doing what the postal system should be doing, but were doing it in private ways, like FedEx and DHL and UPS. And I thought these were all very long-term plays. So when I got these certificates, I said, okay, I'm going to stick them in my drawer and not look at them for 10 years, just let them be. But what I noticed is, after about 5 years, one of the stocks, the IT company, Satyam Computers, I had bought it for 45 rupees, and it was trading at 7,000 rupees. It was up 130 or 140 times what I paid for it. And at that point, actually, I'd been tracking it a little bit, but in about 1999, which was about 4 years after I bought, I said, let me just study this business again, because I know the business, but this is ridiculous, And I noticed that the multiple it was trading at, it was trading at more than 100 times earnings. It was just ridiculously overpriced. And one of the reasons it was priced that way is because they had spun off a .com company, which they still owned a piece of. And the market at that time was in a major bubble for all these .coms. So this company, which was just a system integration IT company, had spun out a subsidiary which was doing some nifty things on the web, and the market gave that spun out company a huge valuation, and because of that, this company got a big valuation. So anyway, I thought this was complete bubble territory, and I was also concerned. The 15,000, the exchange rate had moved against me. The 15,000 was worth over $1.5 million. So, I started with $1 million. I'm going to tell you about the remaining 985,000 in a second. But 15,000 of the portfolio was sitting at 1.5 million. And I was concerned whether the Indian government would allow me to take the money back, whether I could even sell the stocks, whether the shares were fake or real. I had a lot of questions. So I said, you know what, we're going to test this out. So I contacted the broker. I said, I'm ready to sell these shares. And I sent them the shares. They sold the shares. I sold within 5% of the all time high of that company. And they put the money in my Indian bank account. And then the next day, I asked them to wire it to the US, and they wired it. Everything went flawless, exactly as the government had promised. No issues. Okay. I was blown away. I said, wow, no taxes. I gave them 15,000. 5 years later, they're giving me 1.5 million, no questions asked. What a country. And then these other stocks that I had, they were all kind of, you can say, old economy stocks, okay? And they hadn't done much. So the remaining 15,000 maybe was worth 20,000 or 25,000. Had not moved much. In fact, everything else was going down in price at that time except the frenzy for the dot coms. Even Berkshire Hathaway hit a multi-year low at that time. And so in 2001, I decided to completely exit my Indian positions, and I sold all the remaining three. One of them was down 50%, but the other two we made a little bit of money. But basically, for the remaining 15,000, I got like 20,000 back or something. And the overall result in India obviously was more than acceptable. 30,000 in, 1.5 million out is perfectly fine. Then the other 970,000 I had, there was one company I had in there which went up 100x. And I had $100,000. This US company, CMGI, went up 100x. So that one company became 10 million. And so now I had 10 million in that one company. I had the 1.5 million in this one Indian company. And the rest of the portfolio had done okay because at that time, from 95 to 2000, the US markets had gone up like 25% a year. So that it had moved up, but nothing like these other companies. So I had like, I think $13-14 million out of the $1 million in 5 years. And I said, Mohnish, forget about 26%. We've just kind of blown it out of the park. Very well done. Good job. I was very happy. It was a fantastic job, especially for never having even attended a single class of the professor at Peking University. Just, winging it on my own, if you will. And now, recently, I went back. So what happened is these other stocks, when I went to sell them, the other three Indian stocks, they told me one particular stock certificate was fake. So it was a very small amount of shares, but they said it was a fake certificate. And the broker said, we're not responsible for fake certificates. So I didn't really care. It was a small amount. And I just kept that one certificate in my desk. And recently I looked at it again. I said, no, it doesn't look fake to me. So I sent it again to a broker in India to sell. And I asked them, can you sell these 100 shares of this company? So now what had happened is I had held this one company, Blue Dart, which was like the FedEx of India, for 21 years. And I held it for 21 years by accident because that one little piece didn't get sold because of this kind of fake thing. And I traced back because I kept getting these dividend checks all this time and all that. That Blue Dart was ultimately a 60x. So if I had kept those shares, I had invested in Blue Dart, I had invested $7,700, and I would have had about $500,000 if I had kept those shares. So then I went back and said, let me check all the 4 stocks in India. What happened to the other 3 if I had not touched them? Because they were designed to not be touched. I was stupid. I sold it after 6 years. So what ended up happening is that Blue Dart was 60x. There was another one, Kotak Mahindra, which was my broker. That was up 50x. And the third one, which was Skypack, which was a competitor to Blue Dart, that basically went down to half. That didn't do anything. But what ended up happening in that portfolio of 14 stocks in 1995 is I had 4 out of the 14 that all eventually went up more than 50 times. And in one of them, I had a serious position. I had a 10% position, which completely altered my net worth. And then I started thinking that, this is not good, that I ended up with these companies in my portfolio and I never recognize how great they were. I recognized it in two cases. In two cases, I was able to. Now, in one case, in fact, in both the cases I cashed out the 100x were both bubble, because of the bubble, not because the valuations went up. They probably should have been worth 10x or 15x, but not 100x. But so we kind of collected more than we should have, which was fine. But these other ones, these were real businesses like the FedEx of India, the Goldman Sachs of India, and these were businesses I should not have sold, and I sold them. And so I started thinking, how often has this happened in my portfolio? How often has it happened where we've had these companies where I was smart enough to buy them, but not smart enough to hold them? And why is that happening?